Good morning and welcome to another edition of Energy Action's Market Wrap. My name's Scott Easton and I head up the trading and pricing team here at Energy Action. Firstly, I'd like to inform our customers that Energy Action remains open for business. We know energy is a necessity and we intend to continue supporting our customers to secure the lowest cost energy supply agreements during the current uncertainty caused by coronavirus. We've put in place business continuity plans and confirmed arrangements with energy retailers, with most staff now working from home. Our state-of-the-art auction platform, full-service RFP process and workplace planning allows Energy Action to continue serving our customers on the basis of business as usual for the foreseeable future. Today, I'd like to provide an update on the impacts of coronavirus on the electricity market and Energy Action's outlook for future pricing. As discussed in previous market wraps, our first outlook relates to current pricing levels. Prices are at or approaching two-year lows, with prices approaching the short-run marginal cost of black coal generation. This suggests future prices will need to increase to provide adequate returns to asset owners. With over 80% of electricity supplied by black and brown coal and firmed by hydroelectric, it's unclear as to the timing of upward pressure on prices, particularly given the impact that coronavirus is having on our economic activity. Our outlook is for prices to increase from current levels during the next 2 quarters. Our second outlook is the impact of coronavirus on industrial demand for goods and services. We're seeing the decline in economic activity within Australia contributing to lower demand for electricity. Australia's GDP growth is forecast to decrease from its current rate of 2.2% prior to the impact of coronavirus. We expect this will mostly impact commercial and industrial customers, and we're advising our customers to consider their contract provisions around take or pay obligations. Depending on the drop in GDP, this is likely to prolong the period of current low-priced electricity. This will also be influenced by the flattening of the coronavirus infection rate curve. At this point, both remain uncertain. This is why we're recommending customers act now while prices are at the bottom of the current price cycle to renew or extend their electricity supply contracts. Our third outlook relates to water storage levels for hydro generation. Recent rainfall resulting in higher water storage levels at Snowy Hydro have reduced the cost of firming for renewable electricity capacity when weather conditions don't favour renewable generation. This is expected to result in fewer extreme price events and lower price volatility. This translates into more stable retail pricing. Again, we recommend customers take advantage of these conditions before they change. Our fourth outlook relates to continued investment in renewable generation capacity. According to the Clean Energy Regulator, 6,400 megawatts of additional capacity was required to achieve the 2020 renewable energy target. With almost 14,000 megawatts of renewable capacity constructed, committed or approved, the increase in supply, coupled with the outlook factors above, it remains uncertain whether this will translate into lower current prices. Our final outlook relates to the increase in competition as retailers battle for market share. We've seen some retailers offer greater discounting than the forward price for electricity in order to secure additional market share. We expect this is likely to discontinue soon due to the coronavirus and prevailing economic conditions. Our advice to customers is to take advantage of this increased competition now before it ends. So how has coronavirus affected the retail electricity market? Overall, it remains unclear as to the timing and potential duration of the next price cycle. Our greatest impact from corona has been from a decline in industrial and commercial demand for electricity and the impact from uncertainty. One byproduct of coronavirus and current economic conditions is an increase in the potential for credit risk premiums. As the risk of payment default increases due to coronavirus-related business slowdown, we're seeing additional pressure on companies and renewable project developers where credit costs or credit risk premium is being passed on to consumers through higher electricity prices. Our outlook is that these costs will increase over the remainder of 2020 and upward price pressure will occur in terms of electricity pricing. While we don't see the toilet paper effect in energy markets, we are encouraging our customers to seek pricing while substantial savings are available. In our view, customers are best advised to renew or extend their electricity contracts to avoid these increases. Well, that concludes this week's Market Wrap. I'm Scott Easton for Energy Action, and remember, don't pay too much for your energy.